Good morning, real estate mindset community. Welcome to another morning live and happy Monday. So, I wanted to start this out by first talking about, and I know this is going to be a little bit preachy, but don't worry, guys. I have so much to cover on the market, on interest rates. We're going to look at consumer sentiment. We're going to look at interest rates. We're going to look at new construction stuff. So, we're going to go over a ton. But first, what I want to say is I've been getting a lot of comments. Okay, I've been getting, and you guys know I'm always about my comments. I've been getting a lot of comments that are saying, Travis, you've changed. Travis, you look like you don't believe what you're saying. And, you don't have the same energy. What's wrong with you? What's wrong with you? So I just wanted to, talk about that real quick. You guys, here's what's been going on with me, okay? And I'll be very fast. And again, if you're going through the same thing, there's a message here. But I've been burnt out, you guys. Okay, I've been burnt out. I accidentally became a YouTuber and I wasn't prepared for the burnt out. And I've done about 900 videos in a year and a half. So I've been burnt out. And I wanted to let you guys know I apologize for that. And if you guys are also burned out, I want you to remember this, okay? If you're burned out, you don't want to beat yourself up. What I had to do over last week was I built myself back up by reminding myself that I was my own friend. So I built myself back up, and really my conclusion was I had to reprioritize my time. I'm trying to do so much. And really what I want to do for the real estate mindset community is I want to help provide a community where everybody gets to eat. Not just the people that have money, not just the investors with 100 houses. I want to make sure that in this community here, that every single person gets to eat. So I want to show you guys just real quick. This is what I've been up to. And I really had to kind of take a step back because I've been doing too much. But I've been really prioritizing this free home buying course. And a lot of people are like, why are you doing it for free? Why are you doing it for free? Don't do that. But the thing is, guys, is maybe in the future, I'll do some type of premium classes. But like I said, here, if you want to eat, you get to eat. And what we do here is we teach people how to buy. We teach people how to be patient. We remind people it's about you. This is your investment. Buying a home is a huge deal. And you're the one that needs to make up your mind when to do that. So I just want to give you guys an update on my home buying course. So we're done with chapter 1. This is released to the public. I am on chapter 2, and I make a lot of progress. Basically, I have the intro, the payment, and the price completed. So these 3 sections are completed. I'm editing right now, Treat Your Primary Residence Like an Investment. And I've already shot wedge, cash flow, buying incentives, and chapter recap. So in other words, you guys, I'm doing a lot of stuff. I'm doing a lot of stuff for the community, and I keep forgetting to take care of myself. And that's what's been really going on. And I have a new color theme for this chapter. That's my color theme right there. I think you guys are going to like it. So, the way it's going to work is just kind of like the last chapter. You'll have your videos here. You'll have your lesson summary, another video, some helpful link right there. I'm going to start including helpful links, and then a quiz. So, again, I care about you guys. And the proof is in the pudding. I'm going to be the guy that leads by example, leads with action. But I have been burnt out, so I'm sorry about that. Let's get over that part of the video, and let's go right into our market update, because we got a lot of stuff going on this week actually with the market. So we're going to go into that right now. Do I have my timestamp? Yes, I do. Okay. So let's start with and Jeff, I see you, brother. So nice to see you, Jeff, Scrog, Johnny, Christy, everyone. I see you guys in the comment. Nikki, I see you. All right. Anyways, let's go over the economic calendar first so you guys know what's happening this week. We got a lot of stuff happening this week now with tomorrow. So tomorrow we have S&P Case-Shiller Home Price Index coming out. I don't care about that. Personally, that's going to be what, 2-3 months behind? We'll probably see vital signs come on, like Travis, Case-Shiller's up. But vital signs, where are you, man? I'm worried about our boy Vital Signs. I think he's burnt out. I'm worried about you guys. I know it's hard right now, but anyways, Case-Shiller's coming out tomorrow, but also consumer confidence. This is what I'm watching, because right now we need to pay attention to the health of the consumer. The health of the consumer is really what is going to crash things, right? The health, right? Unemployment, not making money, defaults, things like that. So consumer confidence comes out tomorrow, but take a look at Wednesday. Wednesday is a really big day. So we have the ADP employment coming out on Wednesday. We have job openings. We have construction spending that I'll be looking at, but also the Federal Reserve's decision on interest rates. So that's going to be happening on Wednesday. And then obviously Wednesday, Jerome Powell is also going to be speaking. But remember, when we talked to Jack, the Treasury Secretary Yellen, Who's the one that gets high on shrooms again? Is it Yellen? Is that the one that the mushrooms in China? But anyway, she's also going to be talking on Wednesday about how they're basically their next batch of bonds they're selling. So that's going to have a huge impact. So we'll watch that as well. James, it's so nice to see you. I see you, James. Now on Thursday, we're also going to get some really important stuff like initial jobless claims as well. U.S. Productivity will be there. But take a look at Friday. Friday is going to be a huge day of employment info. So you guys keep your eye on that. Obviously, inflation right now is running super hot. What this is basically meaning right now is the market's starting to get it, right? They're starting to understand what's going on, which is higher interest rates for a longer period of time as they continue to fight inflation. I believe the primary problem with inflation is in the housing market, whether it's, looking at shelter, whether it's rent or a mortgage. Now, let's take a look at the 10-year, guys. The 10-year is now, this has been the most crazy thing to watch over the last 4 weeks. I don't know if we'll ever see this type of movement in our lifetimes, at least in the next decade. I mean, the movement in the 10-year right now is astonishing, you guys. This is the economy killer. This is what is crushing businesses. This is causing banks, mortgage lenders, to make less money. It's causing regional banks to have unrealized losses because they have long-term treasuries that are only 1%, 2%, 3%. So the 10-year right now, you guys, this is the economy crippler. Okay, so the 10-year, you can say the 30-year as well, but the 10-year is what we look at. This is high. Now it got to 5%. It dropped a lot last week. We'll look at the interest rates here in a second, but it is up once again. The reason I'm showing you guys this is because there's a lot of pressure. There is a lot of pressure on that 10-year going up, and it is possible that it becomes unhinged. Now, we can't quite stay at 5% or over 5% yet. So that's kind of that next threshold. We got to break through the 5%. If we break through the 5% and hold there, it's probably that pain. That pain is just going to spiral. So let's look at the shorter end. Okay, so that was the longer end. So the shorter end is right here. This is good. This is really good. This is for the sake of argument, the liquidity zapper, the liquidity drainer. So this is pulling out the excess money, right, out of the reverse repo market, out of our deposits as a consumer. So people are buying the 1 month treasury, right? Now the 1 month treasury is up. That's surprising to see. I like that because we need this higher than what the Fed is offering the banks on the overnight reverse repo. And so remember the overnight reverse repo, which is the lifeline to the economy. It's one. Then again, the money printers are also the lifeline, right? Like, geez Louise. But right now, a lifeline is the reverse repo market. So this needs to stay higher than the 5.3% that's being offered. Now, take a look at the reverse repo market. Okay, it's been flat. So we're on that plateau right now. And I think this is the third plateau. So, it's unfortunate. We want to see this drain because the faster that this drains, the faster that the bust comes. But right now there's $1 trillion, y'all. There's $1 trillion of, let's just say, excess money. There's $1 trillion in liquidity. And this is one of the best charts to review if you want to see the COVID money that's still in our system. Okay. But again, you guys remember, we've lost a lot. So I think it's about 50, 60% down. And look at what's happening. So around May, it drops significantly. And then there's that first plateau. You see that? This first plateau drops significantly. Here's the second plateau right here. You see that? And then we're dropping again. And we're on that third plateau. So it's going to be interesting to see what happens with the shorter end of the yields to see if they can continue to pull money out of here. So very, very interesting. Let's take a look at the inversions. Now, here's the inversions. This is really wicked. Honestly, guys, I'm going to go on record and I'm going to say that it is possible. It's going to be hard for me to say this, but I think it's possible we get uninverted this week. Okay. I think that's possible. You heard it here first. Let's watch this. We're at only 15 basis points from uninversion. Okay. So it becomes uninverted, only 15 basis points. That is freaking insane because it's a bear steepening. This is not uninverting because the Fed's cutting the short end of the interest rates, the 2-year. The 2-year is not going down. The 10-year is going up so much that it's uninverting. I don't think this has ever happened, Jeff. Correct me if I'm wrong, but have we ever had a bear steepening? Okay, a bear, the bad one. This is the scary one. This is the 10-year. This is not the 2-year. This is 10-year. I don't think this has ever happened before. This is like super scary, to be honest with you. So we're only 15 basis points away. And remember, you guys, when that blue line goes into the black line, that's when we become inverted. Now, when it goes above the black line, usually it's about 5 to 6 months before recession. You can see that here. So it's uninverted, few months goes by, and then pain. So this is showing us, guys, and this is really what I'm trying to explain. This is showing us that the real pain is right around the corner. This is, from a historical precedent, this is saying we haven't even gone through pain yet. The price drops that we witnessed, that's just the lack of fundamentals. That's just the lack of the sustainability, in my opinion, okay? So once we go into recession, once unhinged unemployment happens, then that will obviously lead to more foreclosures. That will lead to more forced selling. That will lead to even less demand. And that's really where we're headed. That is what these charts are telling us. Everything that I've showed y'all is, and also what the Federal Reserve is saying, we're headed into recession. We're going to have some type of unemployment event. We're going to have some type of credit event. And we don't even know what that is yet. Now, I thought that, honestly, guys, I thought that would happen this year, and it did happen this year. So we weren't really wrong about that. It did happen this year. But unfortunately, they printed it away in March. Let's look at the 5-year break even. Now, this is insane. The market is starting to become a little bit unhinged as far as inflation expectations. This is shockingly important to the Fed. This is, again, the expectations of the market. So the market is starting to price in and figure out oh, okay, higher for longer. Maybe the housing market is overpriced. Maybe we need to fix that. At least that's what I'm saying, right? But look at this, guys. I wanted to explain to you where we're at right now. They need this. They have so much more work to do now. They need this under 2. It shot up and now it's at 2.39. And I want to explain, you guys, the last time, let me see here. The last time we were at 2.39, that was bailout levels. Do you see that? That was back in March. So they're basically forecasting the inflation. The same forecast as when the money printing of $400 billion was going on in March. Do y'all see my point here? I mean, they got a lot of work to do. I mean, when that becomes unhinged, it's just, that's a really bad thing. So watch this if you want to know what the Fed is looking at, potentially what the Fed is going to do next. And again, this just means higher for longer. Now let's look at VIX. Let's look at the volatility in the market. So the VIX is holding about $20. So it's kind of going up and down a little bit. I think we got up to $30, didn't we? Let me see. I think we got up to $30. Oh my gosh. Look at, so the 3-month growth has been 48%. Do y'all remember me talking about this when it was at $13? Again, this is measuring the volatility. It's just something that we can watch to figure out what is going on in the market. I mean, the market's sideways. Half the market is optimistic. Half the market is scared. It's very, very difficult to get a read on this. I get that. Let's move on to the next thing, guys, which is oil. This has been, a lot of people have been watching oil. Obviously, we have tragedies in the Middle East, Israel. We have all this stuff going on. So the oil actually blew up. I'm not sure what it got to. I don't know if you guys remember. I think it got to the high 90s or mid 90s. So it got to the mid 90s right when Israel got attacked, and it's gone down. So I'm actually really surprised that it's only $84. So keep your eye on oil. That's obviously would hurt the inflation. Now look at the US, guys. I'm not saying directly that the US is a bully, but geez, guys, the US is kind of a bully to the world. I mean, it's kind of a bully to the world. Look at what they did with Australia and Russia after the sanctions. What? But anyways, you guys, the dollar is crushing the world right now. If this continues to go up, I mean, this is if the US wants to go to war and not fire a bullet, they can manipulate the dollar. This is a measure against the world currency. So the dollar is extremely strong right now. So it's going to be interesting to see what happens with Yellen and see if this actually goes up, because if this continues to go up, it's going to really cripple the rest of the world. So anyways, that is our quick market update. We're going to go into our first video, and then we'll do our mortgage update and a few more videos. And then I'm going to show you guys some really cool stuff on MLS that I think you're going to like. But I figured that we would start here. This is going to be from a rep at Vanguard, and they're going to talk about basically where rates are headed. He's a bit bullish, but they're also starting now. These bulls are starting to talk about how amazing, how amazing these yields are, how amazing the T-bills are, the 5% yields. It's risk-free 6% yields. They're basically starting to say, if you're a long-term investor, dude, don't waste your money in stocks. Don't waste your money in real estate. For the love of God, buy some T-bills for 2, 3, 4, 5 years, because we haven't had this happen in decades. So they're now starting to shift, and that's actually not a bad thing. So we're going to play that video right now, and I hope you guys enjoy. Let me know if you can. The audio is okay.
We're back on the halftime report. Senator Bob Pisani now with today's ETF Edge. Hey, Bob. Hello, Scotty. I am here at Vanguard headquarters in Malvern, Pennsylvania. I am sitting on the company's brand new trading floor, and it's beautiful. Vanguard is now the world's largest mutual fund and ETF provider, and it's the second largest asset manager. $7.8 trillion in assets under management. Think about that. Let's talk with the man in charge of those ETFs and the chief advisor here, Greg Davis, Vanguard's chief investment officer. Greg, before I ask about the ETF business, the one thing on everybody's minds, direction of interest rates right now. What are you telling Vanguard investors? Where are interest rates heading going into the end of 2023 and into 2024?
Well, thanks for the question, Bob. What we've been trying to tell investors is that they have to stay invested for the long term, and that the higher interest rate environment that we're in right now is something that for long-term investors, they're having an opportunity to actually be more diversified. They have an opportunity to be in money market funds that are offering a 5.25 type yield. So something they haven't seen in over a decade. There's opportunities in the fixed income space that we really haven't seen. So for our long-term investors, we think there's a lot of compelling value, not only in money markets, but bond funds. And then ultimately, when you talk about the direction of interest rates, again, we think the Federal Reserve has a couple more hikes potentially in store because the markets are still operating at a relatively high level.
Are rates going to be higher a year from now? They're still going to have those 5.25% money market funds?
Yeah, I mean, what we think is the Fed has a good potential to raise rates at least 1 to 2 more times between now and the end of the rate hiking cycle. And then the goal is for them to stay at an elevated level for longer because the economy is still running at a relatively fast speed. Inflation is still relatively high, above their targets. And so we think they're going to be elevated for an extended period of time.
Now, you said in January to expect below average returns for stocks in the next few years. You talked about 4.7 to 6.7% return. That's historically below average. The S&P is up 7-8% this year.
Yep.
Why should we be expecting below average returns in equities in the next few years? What's the problem here?
Yeah, so a couple things, Bob. First, I would say that forecast that we gave you was for a 10-year time horizon, right? So yes, you're right. The equity market's up about 8% this year. But again, when we're looking out over the next 10 years or so, a big part of that is driven by valuations. When you look at where valuations are today relative to other asset classes, U.S. equities just don't look as compelling. And so when we're thinking about U.S. equities, we're expecting a 5% annualized return for the next decade. We think the international markets offer more value because valuations are more appropriately priced.
You run a $2 trillion ETF business. That's one of the largest in the world. You're the two biggest that are out there with your competitors out there. What are you hearing from them? Where are the flows going this year, and where do you anticipate seeing them in 2024?
We've taken in about $105 billion in flows this year. 2/3 of it has been into the equities. And I'd say when you look at equities specifically, it's been driven into two products, primarily the S&P 500 index and total stock market. When you think about the other third that actually went into fixed income, the majority of it went into the U.S. ag product, total bond, and the other component was the global ag. So nice diversification across equities and fixed income.
So index is still winning. That's the bottom line right now. Okay, we're going to have a lot more coming up on Vanguard's economic outlook for 2024. That's coming up. Greg's going to give it to us along with his outlook for stocks and bonds. He'll be joined by Janelle Jackson. She's Vanguard's global head of ETF capital markets. Here's your chance to learn more about Vanguard's very large...
All right, we're done. If you guys want to go check out Vanguard, go check out some Vanguard. So we're going to go into our mortgage update. But real quick, I saw this comment, and I'm not going to bash anyone. And I appreciate every single person commenting. I don't know if this is straight drive. I had to kick him the other day. I just couldn't. That guy was just so out there, man. Anyways, if a recession happens, interest will come down, okay? And housing prices will skyrocket. So I hear this from a lot of people, Skywatcher. I'm not knocking you, and I understand why you're saying it, right? You're saying it because there's this lack of inventory, and if interest rates go down, like everyone's going to go buy a house, right? Even if they don't have a job, right? Even if there's a recession, unhinged unemployment, they're just going to go buy a job. Even if there's a foreclosure crisis, right? They're just going to go buy a house. So I understand what you're saying, but how? How are they going to buy a house? I mean, because again, what I am continuously trying to explain, we have a 7.4 times PE ratio. They've already squeezed the juice out of the housing market. That's why we have higher for longer. If we didn't have an issue in our housing market, we may already be towards, we may be done. But Jerome Powell increased interest rates as far as like the total amount of percentage increased, like double, right? He increased interest rates faster than Volcker. So probably because of the PE ratios and things of that nature. So I understand what you're saying. Maybe I'm wrong, but and this is why you guys, here's the thing with what Skywatcher is saying. Yes, none of us have a crystal ball. None of us know exactly what's going on, which is why I constantly tell you, understand what your goals are right now and look for them. And if you find that dream house, buy it. The thing is, though, what I'm also saying is right now that's almost impossible to do. And a lot of people get caught up in the emotion and the fear of missing out. So they may go into purchasing a house with great intentions, but they may end with something they didn't want. And we see that in these buyer's remorse surveys. There's no question about the regret that's going on right now. But I just wanted you to know, Skywatcher, I do understand your point. And anyone that says I understand the point that they're making, I don't agree with you, but I definitely appreciate you commenting. So I just wanted to say that, okay? No hate. All right, now let's go into the interest rate update right now. And I'm going to do a quick timestamp for that at 20 minutes. So we're going to do our 20-minute mortgage update. So here's where we're sitting with mortgage updates, you guys. So you guys should know by now that the true interest rate is not 7.88%. But right now, on average, it's saying, according to Mortgage News Daily, interest rates are sitting at 7.88%. But remember, how do you know what the true interest rate is? Okay, usually you times, I'm going to give it to you guys right now. Okay, usually you times the interest rate by 2 and add a 0. Okay, so if the interest rate is 7 times 2 is 14, add a 0, 140%. Okay, so right now, the true interest rates, what are the true interest rates, guys? No, because I hear the comment like, hey, if you rent, it's just 100% towards interest. It's just 100% towards interest. What's the true interest on a mortgage right now at 7.88? 150%. Don't forget that. Don't forget that. And honestly, you guys, in most every metro area, it's over 50% more expensive to buy a house. And that's not even counting the down payment of $90,000. So more expensive, and you need $90,000 down if it's a 20% down payment on the average priced house. Doesn't sound so appealing to me. But anyways, we're sitting at 7.88%. Take a look at the market. Take a look at what the market's doing. Now, the market is written off the Fed. They are saying that on Wednesday, there is a higher possibility of a rate decrease than an increase. That's what the market's saying. How are they saying that? It doesn't make sense to me. But anyways, guys, they've completely written off a second rate hike in November. Let's look at December. December is about a 0.25% chance of a second rate hike in December, sitting at 24.5. You guys know I like to look ahead and, I like to move the space-time continuing forward a little bit and look at the future. Now, I want to look at next spring and summer because unlike in 2023, we need buying demand and seasonality crippled and crushed in 2024. We need that to happen. I don't care how much inventory there is. I don't care if there's 1 million units, 1.5 million. I don't care. We need the buying demand crippled like it is right now. Okay. And we were well on our way this year, but again, they reversed the quantitative tightening. Interest rates dropped. But in July, it's sitting at about 24% likelihood of rates being where they're at right now. Okay. So 25%, not the best, but June is a lot better. June is sitting at roughly 40%. So far, this actually looks really, really good. And I hate to say it. I know it hurts. I know there's a lot of pain, but this is exactly what we need. Okay. This is, if you're a homeowner, this is probably not what you need, but for us, this is exactly what we need. Now, let's look at the amortization schedule because I always like to remind you that, in my opinion, a 30-year mortgage is the second worst debt in the U.S., followed by credit cards. And the reason that is it's front-loaded with interest. If you guys get the average loan amount of $328,000 at today's interest rates of 7.88%, you would actually be paying back $856,000. $856,000, okay, on a loan amount of $328,000. Okay, Chris, I see. I don't know. Oh, dude, he's bragging about it. Chris, mine's 2.5. So I'm gonna brag. I love my 2.5, Chris. I love my 2. I have a 2.5%. I thought it was 2.375. It's 2.5. So let's pat each other on the back and let's continue. Now, what I like to remind you guys is if you pay, you can pay the amortization schedule down after you close. So if you pay after you close 5 years off, it would only take you $16,518. If you guys paid $16,518, you would save $126,000 in interest. That is the power of amortization schedules, okay? That is why banks make so much money, and that's why you see people want to do owner financing all the time. Like, I've done an owner financing deal on my forever home. I've had like 4 forever homes. I had never had any intention of moving or actually moved. So I have done owner financing on a house, and you guys, it's very, very profitable. So They paid the loan off in 5 years, by the way. The owner financing I did. So we always encouraged them. We always gave them love and grace, and we're really proud of them, actually. But we're going to go into our next thing, which is going to be, what do we want to look at now? Do I want to do consumer sentiment? I may do consumer sentiment. I'm going to show you guys. We're going to go over a video on
when we challenged ourselves to.
And basically, this is so crazy. So right now, guys, and again, I'm letting the ad play right here. I want you guys to comment below. Let me know, do you think that consumers overall are doing well? I know like the upper 10%, upper 1%, they're doing great. But I don't think consumers are doing well. We see credit card debt absolutely explode. We see defaults absolutely explode, despite what Fred economic data is saying. We have updated information now on credit cards. The delinquency rate is near 2007. Same thing with car loans, you guys. Bankruptcies are exploding. The job market's still hot. The part-time job market still hot though. Part-time job market still hot, right? We can say that now, right? Because we know it's part-time jobs. So let's see how the consumer is feeling about stuff right now.
Final October consumer sentiment coming in at 63.8. That compares to the 63.0 estimate, and that itself compares with 63 from the preliminary data earlier in the month and 68.1 in September. So still down month over month on Michigan sentiment, but just slightly better than anticipated.
Just adds to the string of better data releases.
It does.
I think we should talk about PCE.
Sure.
Well, first of all, let's talk about personal spending, which comes out in that number, which was strong. And we knew that, right, because that factors into the GDP that we saw yesterday on the third quarter. But 0.7% month over month growth in September versus 0.4% in August is a notable jump and better than a consensus. And then headline inflation comes at a little bit firmer, 0.4% versus 0.3% expected. Core, if you strip out food and energy, which we know the Fed likes to look at for the underlying trend, 0.3% versus 0.1% prior. So a little bit hotter, but if you look and zoom out, the downtrend is still in place on inflation. So it shouldn't really change the macro narrative or change the Fed's trajectory, at least next week when it's going to pause at its meeting. At least those are the expectations. But it does keep them on high alert, Mike, that this stronger data may make it harder to bring inflation all the way back down to trend. And that's going to be the story. And today's data didn't do anything to change.
Yeah, consumer high debt spending. Good point right there. That comment. Consumer high debt spending. Good comment. Good comment. All right. So anyways, guys, the consumer's not doing too well. They're starting to get it. But, remember, we're coming out of COVID where for the first time in our lives, we had thousands and thousands of dollars printed for us, and then deposited into our bank account. Oh my God. That's never happened before, by the way. So we're going to move on to the next thing, guys. We're going to go and explore new home sales. And I got a banger video I'm hopefully going to make today. I actually did the video already on Jack's channel, Nobody Special Finance. And I'm going to show you guys things that are going to blow your freaking mind. I'm going to give you guys a little bit of a sample today of what are some of the things that I found with new construction. But let's start with this video, basically listening to TriPoint and how they're doing with new home sales. And I just want to remind you, all the optimism with these new home builders, understand their profits are down. TriPoint's profits are down 22%, and they're doing crazy buying incentives, and everyone's like, oh, they're doing so well, but the profit's down 22%. All right. Anyways, guys, enjoy the video.
Shares of TriPoint Homes down more than 2% today, despite posting strong third quarter earnings results last night. The home construction company reported a beat on both the top and bottom lines, surpassing delivery guidance and posting a record low debt to capital ratio of 32%. Still, TriPoint saw a 22% decline in year over year home sales revenue, with new home deliveries also falling 16% from the same time last year. For more here, we're joined by TriPoint Homes CEO Doug Bauer. Doug, welcome. Good to see you. Some of the numbers very nice, beating expectations. Others of the numbers a slowdown from last year. I suppose no one should be really terribly surprised at that, should they?
No, Tyler, thanks for having me on. As you pointed out, we had a strong beat across the board. And even with increasing rate trends that we've seen, we had solid absorption. When we measure absorption, and we look at sales per community per month, and our number was 3.3 in Q3, which is very good. And we also have a really strong setup for the fourth quarter. as we finish the year, 86% of our backlog is locked in with our mortgage affiliate at 6.6%. So it's a very solid quarter, very solid year that's set up for us. So I'm very bullish on this year, and I'm very positive about going into 24.
For those of us like yours truly who don't understand some of the numbers like absorption, you just cited a 3.3 number on absorption as being very good. What does that mean? I don't know. I'm educated.
Typically, the industry, depending on your price point, you want to sell for each community anywhere from 3 to 4 homes per month per community. So think of it that way. 3.3 is a very healthy rate. We plan our business around 3.
Real quick, guys, did you hear what he said? So they want to sell 3 to 4 homes per month in a community. I just walked a community where they had 180 spec homes. Anyways, and we only have 6.9 months of supply. You guys see the problem? We got a hyper supply right now with new construction overall. Obviously not in Jeff's metro area and some San Diego. I know that. Anyways,
0.25 to 3.5. So it's a very healthy rate despite the increasing rate environment that we've seen.
I guess what strikes me about folks who are in your business is this. The interest rate environment affects housing affordability. But when you get to the bottom of it, there is a shortage of housing in the United States. Inventory is low because owners of existing homes aren't putting their homes on the market. So who's gonna serve the need of the housing shortage? It's builders of new homes like you. You're the swing player here, right?
Tyler, you hit the nail on the head. If I could throw a proposition to you, if you could be the CEO of TriPoint, and I just told you that your main competitor, which is the resale market, is not producing or selling about 1 million to 2 million homes per year, that translates into a greater market share, greater top and bottom line growth. And that's exactly what's happening. In addition to what you were saying, there's been a shortage of housing built since the great financial crisis. It's millions of units, depending on who you want to talk to. So the new home builders are well positioned to provide product to the millennials, the Gen Zs that are really entering their prime home buying years.
And as you point out, some of those Gen Z folks are buying homes at a younger age even than the millennials. Let me ask you one thing here that did leap out to me. If indeed new home builders are the swing player here, new home deliveries 1,223 compared with 1,463, a decrease of 16%. I think that's year over year comparatively. Why are those new home deliveries lower if, in fact, the new home builders should be getting a bit of a boost from the fact that they're kind of the swing player in the market?
Well, orders, I believe, were about 122% above last year. You're comparing deliveries. And what happened last year, the Fed increased rates, as you know, 7 times. So the consumer paused for about 6 to 8 months, but then re-engage as we got into 2023. So that comparison to 22, we're pretty much blown. All the builders are blowing that out of the water when it comes to orders, and it provides a really strong setup for 2024.
All right, really strong setup, right? Again, you guys, their revenue is down 22%. I understand the lack of existing inventory. So I was thinking to myself, right, let's say that we go into 2024, okay? Let's say we get to 2025, all right? And something bad happens. First of all, the only way that the rate, we all know this by now, but the only way that rates are going to go, mortgage rates, that's what we're talking about, okay? It's obviously it's influenced by what the Fed does, but if we go there and mortgage rates go down, which they'll only do if something very bad happens. If nothing really, really bad happens and they start cutting rates, it's going to be very, very small cuts. So it's not going to happen overnight, again, unless something is broken. But say something gets broken, okay? Say that there is this hyper supply of new homes. Like I'm saying, there's a hyper supply of new homes. And that's obviously, it's going to lead to prices going down. I'm going to tell you that now. I have no doubt. It's already happening in Texas. Texas has the 4 leading metro areas of year-over-year decline. And when I look at that, I'm like, well, the new construction. Texas has the most new construction. Therefore, 4 metro areas, number 1, 2, 3, and 4 at the top, declining. But say that initial price decline happens, but then the builders are like, screw this. We're not going to build. We can't sell our houses. Okay. Then that will create an additional problem. Because in my opinion, we're going to be okay, but we're not in a vacuum. So we still need the builders to build. So again, say they are in distress, okay? Say in 2025, they're in distress. They start going under. Maybe foreclosure spiral. The Fed has to act. They cut rates. Mortgage rates go down, say, to low 6s, high 5s to save the builders, to sell their products. But remember, guys, if again, we got to make it to that long. What happens when rates go down to 5 to 6? What happens? I'm going to tell you guys right now, we will have overnight, probably, if depending on where rates go and how quickly, at least 1 million existing home listings. At least one, all of the people that are on the sidelines that want to sell their house, that are dying. Maybe it's a divorce. Maybe it's a medical issue. Maybe it's a job relocation. Maybe they just can't afford it. Maybe they got to get out because there's a barking dog, planes flying overhead. Who knows? But people are used to being able to move. They haven't been able to move for the last 2 years. So if the builders are in distress, they drop, or someone is in distress, they drop rates to 5%, there's going to be the initial massive influx of inventory. The thing is this. Who knows how long that's going to last, right? There's going to be a period where there is that buying opportunity window. I have no doubt about it. But then again, we also understand how corrupt the housing market is and how much capitalism is in the housing market. So we also have to constantly, at least I am reminding myself, what do I want? How do I get it? Follow the data, okay? Even though I think it's probably going to be a better deal, I'll find it easier to find a better deal in 2024, 2025. I'm looking today because I don't want to miss out on that opportunity, okay? And we don't know what these institutional investors are doing. But here's the thing, you guys. If new home builders were doing so great, okay, let me show you what I found. New home builders right now, okay, this is MLS. New home builders right now, you see under my picture, they're trying, look at how much, they're raising their freaking commissions to the buyer's agents to 5%. Normal commission is 3%. Okay, so this is Lennar. This is in a specific community. Remember, you guys, different subdivisions have different levels of distress. Some new home build community subdivisions are okay, but the newer ones that have a whole bunch of spec homes are not okay. So now we're starting to see them almost double the buyer's commission. How can you not have a financial bias if you're an agent? So say there's 2 new home builders next to each other. One new home builder is offering me a 3% commission. The other new home builder is offering me a 5% commission. Come on, you see the problem here? I mean, how do you ignore as a buyer's agent? I mean, it's easy. You just worry about your customer. But I'm saying most people are not going to ignore that. They're jacking up instead of decreasing the prices. They're paying the agents to get you there more money instead of reducing the prices. I think that's astonishing. But not only that, guys, look at what else, okay? Now, I already did, okay, the shadow inventory. So here's an example of Harrington Trails. I actually was driving down 242. And I was like, oh my God, what is this? I didn't even know that this was here. Okay. Now this shows 43 homes listed, active, not under contract. This is just active right now. Now, you guys, there's 2 to 3 times more inventory in some of these subdivisions that's even being reported. So when I zoom in here, remember, you guys probably saw the video. When I zoom in here, all right, let me zoom out a little bit. Look at all of these houses are complete. These are the streets right here where there's only dirt. These are the streets that I drove down where there were houses lined up side by side saying, okay, this one's sold, this one's available, this one's all of it, guys. And I counted, remember, what was it, 150? It's reporting 43 active, but again, and I missed inventory when I was walking. I could not keep count. There was too many houses to count. I counted 150, and I know I skipped 10 on there, so I was watching back. I'm like, oh my God, how did I do that? But you guys, walk new build communities. If you don't think there's a lot of inventory, then walk it. If you guys go to new communities like this and you find a whole bunch of inventory, more than likely you're in a metro area that will experience price decline as a result of the hypersupply with new builds. But is every metro like this? Sadly, no. St. Louis, not really like that. San Diego, not like that. So it is local. And even if you do have new builds, remember, you guys, this is a subdivision that's in distress. But when I zoom out, this subdivision right here, actually, this one's also in distress. This was the other one I counted that had 150. But like if I go over here, like if this is a subdivision, that one's okay. You see, this subdivision right here, maybe not okay. So it depends on the subdivision. Every subdivision is unique. I don't ever want you to, forget that, you guys, because remember, if we want to figure out whether or not the price cuts are true price cuts, because we see Lennar dropping 21%. I just did this video, 21% price drops, by the way. But how do we know it's real? And how do we know it's not some, con or ploy to get us to buy a house and feel like we got a great deal when it was just our feelings? You got to look at the comps. You have to look at what properties sold for in the subdivision, not in a different city, not in a different subdivision, in the property subdivision. So understand that's important. Now I'm going to quickly, what else are we going to go over real quick? Oh, okay, we're going to go over one more video as well. Let's look at China real quick. So China right now, you guys, is not doing well. China is going through what I like to call a 2008 real estate meltdown. Okay, they're going through a great financial crisis right now, specifically, you guys, in real estate. China is burning alive with real estate. So I'm not going to read this whole article, just some bullet points here. This was released this morning. Okay, so this is from this morning. Evergrande shares fall 20% to all-time low as court adjourns winding up hearing. So a little bit about Evergrande. Evergrande shares plunged 20% from last Friday, blah, 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 blah. But Justice Linda Chan from Hong Kong's High Court said December 4th hearing would be the last before a decision is made on the winding up order. Look at this. Look at this picture. I want you guys to breathe that picture in. Those are like skyscrapers. Those are like, high-rise apartments that are abandoned. You're looking at the new Las Vegas ghost town, but in China with high-rise skyscrapers. The way they do things in China is they charge the consumers before it's done being built. So they burned. Think about it. Think about how blessed we are. First of all, we have fixed rate mortgages. Okay, so we're blessed there. But they got 100% screwed. The Chinese people got 100% screwed. And it's like so difficult to fathom for me. Like, too bad they don't have the earnest monies, like we do. But look at that, guys. Look at how many buildings they're abandoned. That's way crazy to me. Oh, my God. Anyways, here's their stock. Looks like their stock is at 21 cents. Evergrande stock's at 21 cents, down 9%. And if you guys want to come back here, you can read all this if you want. I'm going to spare you some reading. You guys know me with the slow reading group, but we're going to go into our last video right now, which is going to be basically on the inflation that came out last week, 0.3% rise. So I wanted just to kind of round this video up by by having them break down what happened last week in the economy. And again, you guys, this is where we will be ending the video portion, and then we'll get into the Q&As. Okay. So I love you guys. Thank you for hanging out with me. I hope you're getting value. And here's our next video.
We do have some data that's hitting right now. Steve Leisman is standing by with that breaking inflation data. Steve, what can you tell us?
Personal income 0.3%, Becky. That's a miss on the 0.4 that was expected. Expenditures, wow, big jump there, 0.7%. That's above the expectation of 0.5 on the important price indices. Headline at 0.4 and ex-food and energy at 0.3. So that is right in line. That's the core that people are interested in. Year over year, the headline does tick down. It looks like 0.1 to 3.4%, and the core just 3.7. So that is exactly in line. Really in line numbers, Becky. There had been some talk about whether or not this number would show something of a tick down below expectations because of the data yesterday, or the positive core PCE data in the quarterly GDP report we got yesterday. That was not the case. A touch light on income. I've got to figure out where that came from, but the spending number was strong, and I'll have to look. My guess is that the personal savings rate, yes, it did. I guessed right. It fell to 3.4%, running well below the average of 5%, 5.2% is the average of savings over the last several years. It is down. People are running or using savings to keep up with their spending. Whether or not that's a smart choice or not, I guess that's up to the folks that are doing it. Prices for goods were up 0.2%. Services, a strong up 0.5%. And one of the things we'll be doing as the morning goes by is calculating that super core number that Fed Chair Jay Powell looks at. That had been very, very well contained, 0.14%, but I don't know what it is in September yet because we have to calculate it. Becky?
Hey, Steve, let me just run through like a broad overview of this. If you have people who are spending money faster than expected, even as their incomes are rising slower than expected, they're taking down their savings by more than anticipated to keep up with that savings, that could tell you one of two things. Either people are feeling pretty good about this economy, or they are being forced to tap into their savings just to keep up with inflationary costs that are rising at a faster pace.
Right. And just to make it more confusing, there's a third possibility, which is that both things are true for different cohorts of people, right? There could be a lot of stress, for example, at the low income trend. You could have folks who are on the upper income part that are feeling comfortable with what they're making. The job security numbers we've seen, Becky, for example, in our CNBC All-America Economic Survey, have been pretty strong. People feel pretty good about their jobs and their job prospects. Among 7 financial, areas of stress that we polled about, job security was the least stressful, or the other way, people were the most comfortable about it. In that context, you might be spending more of your income, more of your savings in that regard. We also don't know the level of savings that people have. So it could be that people feel like I've got the money for the rainy day, and therefore I'm okay in this month spending a little bit more of my income. That is not to diminish the stress part of that explanation that you put out there, which is indeed people could be stretching to make things work. You still have relatively high inflation, not only high inflation, but you have a relatively, high price level. People are not quite used to that price level yet. Although one of the things, just to contradict myself very quickly here, one of the reasons that was put forward, why are consumers out there spending? Prices for some things may have come down, that may have induced some to come in and do some spending that they may have held back.
And maybe the inflation is so high that people are using their credit cards to buy things, and they're chasing after, chasing that comfort life that they got used to. Who knows? That's what I think is happening. That's what I did when I lost everything. All right, guys, I'm going to go into some really good Q&As right now, and then we're going to wrap this bad boy up. Okay, so let me pull up some good comments here. Let's start from the beginning. I do the best I can to, if I throw up a comment, usually it means I'm going to go back and address it, but sometimes I can't cover everything because some of these comments are just really good. You guys are amazing, by the way, especially like House Hacker, the realtors that are here, even Skywatcher. I mean, how blessed are we to respect each other enough to talk to each other? I mean, we're just so blessed. And if you guys want to join Discord and talk as a community after YouTube, remember, in my description, click Discord. You can sign up. Also in the description is my free home buying class. Now, Jim, Powell won't be bullied again. He has no choice but to drive the economy off a cliff unless he believes a soft landing is possible. And Jim, I've heard this actually. I don't know how true this is, but I was talking to Todd Sachs, which, by the way, my gosh, his channel is blowing up. If you guys want to get some really hot real estate content, go to Sachs Realty. That guy's a huge inspiration to me. But basically, there's rumors that Jerome Powell, who's has $100 million, he's going to retire soon, and that Biden wants to fire him. So a lot of people are saying that Jerome is going to screw us up because it needs to happen, and because he's going to retire, and he doesn't care about the pressure that the administration is putting on him. I want to believe that. I still, for me personally, the jury's still out on Jerome Powell. I'm still pissed off about the bank bailout, to be honest with you. But again, I want to believe in him. But first, I'm going to believe in myself, right? So I'm going to worry about myself. I want to believe in him. I hope he doesn't want to get bullied. I mean, Jim, think about it. I mean, he's at least held 2% this whole time. He's got a lot of pressure to go off of that 2% goal. He's held us at 2%. It's still there. The market's trying to force him to 2.5 to 3%. So right now, I'm slowly turning around on my approval rating for Jerome, but it is not good, though, because, again, the low rates also messed us up, and he said it's a transitory inflation. So overall, I think it's complete trash. Anyways, keep looking at the sky. Recessions never lead to higher prices. So I brought this up because that's not necessarily true. It's not necessarily true. When we've had recession, like if we look at the 70s and 80s, okay, and this is where the premise comes where real estate is a great hedge against inflation. 70s and 80s. 70s and 80s was a great hedge against inflation. Prices actually went up for home prices during the 70s and 80s recession. So I thought I'd bring this comment up and let you guys know that it's important to review, because I thought it was important to review. So I reviewed why did prices go up during those recessions. And the thing is, there's another part of the equation that was there that's not there right now, which is the strong consumer. When prices went up during the recession, consumers were saving at an 11 to 12% interest. Okay, so 11 or 12% of their income, they were saving. They were yielding 14% on savings accounts. The PE ratio during the early 70s to I think 1978 was under 4. We're at 7.4 right now. So not only do we have the health of the consumer in during that time being extremely strong, home prices had the ability to go up because the PE ratio was historically low. People don't want to talk about that when they say, oh, it's going to be like the 70s and 80s. Well, it was historically low PE ratio. Right now we have historically high PE ratio and historically low savings and things of that nature. So, but after that, yes, those recessions have crippled a lot of things. But I'm saying that because this is different. This one, we still don't know 100% what's going to happen in this recession. And think about that, guys. It still has the potential to be a depression. Like, how do we not know that? It's just a really scary time. I wonder how hard the Fed is going to keep going. So another comment from BRN. We need to stop worrying about everyone else's business for us to take care of ourselves. Exactly. That's what I was. Well said, sir. And I think if recession happens, I think I already talked about that. Okay, so here's one from Jeff. I agree, but the savers always get, this one hurt to read. Okay, this is from Jeff. I love you, Jeff. I agree, but the savers always get footed with the bill. Trust me, I'm with you, but that's not how our system works, unfortunately. I'm going to have to push against you, Jeff. At least in my household, at least my morals, my ethics, I'm still living in the American way. I'm still saving my money. I'm teaching my kids how to be good savers. I'm disciplined, and I'm empowering myself through that discipline. I'm making sacrifices. I'm not ready to give up on America, Jeff. I'm not ready, man, but it feels that way. But I just wanted to say, I think we could really all just boil it down to COVID, because remember what COVID did to us. I think it's just COVID, Jeff. And I think what the people are trying to do is normalize what happened during COVID and turn that into a normal world for us. And I just am not ready to accept it. It is ugly out there, Jeff. We are getting taken advantage of. The bailouts do hurt. I won't say it is. I don't think it's fair, some of the things that are going on, but I will not change my ethics and my goals and my morals, bro. And I don't think you should either. And that's why our mindset is so important. That's why I started with mindset. BR, another great comment. Yeah, I still do not think businesses will raise wages enough, though. They're starting to feel the squeeze, so I'm not sure about that. I mean, some will, but I doubt most will. So basically saying that, come on. I mean, okay, so and I did this video with Jack as well. Profits are going down. They can't raise the prices because the prices are too high. Consumers can't afford it. And labor costs are going up. So if they're not making as much money, they can't raise their prices because they're too high. Labor costs are going up. What does that mean? It means unemployment. And that's what's happening. Travis' spouse has a major fear of missing out to buy a new home. I'm on the side of wait and see. And how can I convince her to wait and let this all play out? First of all, MFH, she should be the one convincing you, because in my opinion, we should be making purchases of this magnitude together. Spouses should empower each other, be each other's best friends. So the thing is I would just turn that around but I have a different answer. I'm just saying, I would just ask her, she's got to convince you to spend your money. So if she's having a hard time, show her, because I have a hard time too, because I have children and I want to be a leader in my house, a servant leader, serve to lead in my household and provide my children with somewhere they're going to live for the rest of their life. And I want them to meet friends around the neighborhood. And so it hurts me, and I do get sad about it. But all I do, MFH, is I just look at houses. Just look at houses and then calculate the payment. And then okay, I'm good. So I would just say, show her the reality, MFH, show her the PE ratio, show her the price, and show her the mortgage payment. Say, if we buy this house, it will cost us $90,000, and here's what our payment would be. Is that something you're interested in doing? Right? And I would also, if it's me, because I'm not giving personalized financial advice. If it's me, MFH, I'm also saying, and let me take that $90,000 that you want to use to buy a house. Let me put it in T-bills. And then I would show her, look at this, $400 we're making a month. Do you want to trade in that $400 we're making a month to pay $2,000 more and to waste $100,000 of our equity? So I think the hard part here, MFH, is security. I think that for a lot of us, that dream of, the American dream starts with that home ownership. Adulthood starts with home ownership. And I think if we really analyze that, she just needs to know that she's safe and that she's secure. And who better to do that than you? It's not going to be a house. In fact, if you buy an overpriced house, another thing, MFH, here's what you do. Show her the buyer's remorse surveys. Show her those buyer remorse surveys and show her what people are saying. And honestly, it could put a lot of pressure. If you think there's a lot of pressure now, buying an overpriced house, potentially losing your job, there is going to be way more pressure if that happens. So in other words, MFH, Godspeed, sir, Godspeed. But we want to be doing things with our spouses. Mike has a comment here. I suspect builders will keep houses at 90. This is good, 99% finished, so they don't have to report it as inventory. Why would they do that, Mike? Okay, so other than making it appear that the prices are inflated, why would they do that? Okay, if you guys know, comment below. There's two reasons. Both are bad, actually. So one reason maybe, comment below, but one reason maybe they got too much inventory, like we saw in Harlington Trails, we saw Tavola, we saw other places like that. But what's another reason? And this is where I think they need to make new laws. Okay, they do this, Mike, because they do not want to pay the assessed value on that dwelling for property taxes. So they're avoiding property taxes as well. Imagine this, okay? Imagine you have a house built and say it's just missing the front door, just missing just one thing that would take 20 minutes. So 20 minutes and it's complete. The builders aren't going to do that because right now, like all the houses that y'all saw me drive by, they're paying probably on all of those houses, they're paying property taxes, and they're high in Texas, like 3.5%. So say they're 3.5%. They're paying property taxes on the dirt. So they're paying property taxes on like $15,000. The moment that home is complete and the county goes back out to reassess it for taxes, if there's a dwelling that's now completed, it can go, their assessed value can go from $15,000 to $400,000. So their property tax liability can go up, 25 times? Should that be against the law? We have to pay taxes. Should it be against the law? Should they have to report that? Should they have to pay property taxes? If they pay property taxes, wouldn't that mean they would try to sell their houses faster? Right? Wouldn't that mean if they had to sell their houses faster that they would potentially cut prices? It does mean that. So there's loopholes. And I'm telling you guys right now, there's such a lack of regulation and transparency with these new builds. It's really sucky. Okay, Art Caffeine. I like your profile picture. That's super cool. Travis, like Vegas. How, Travis, how? There's no ghost cities here in Vegas. These real estate agents are lying to buyers, and it's still hit market over. I think it's still hot. Still hot. So I just wanted to clarify. I was talking about the Great Financial Crisis. So during the Great Financial Crisis, like in 2010, and like maybe about 2010, 2009, there was entire communities, you guys, in Las Vegas, brand new built communities where every freaking house was a foreclosure or a short sale. So they were like, and it wasn't just one. They were all over the place. Like, and that's why I was referring to ghosts, like ghost subdivision, ghost community, like in Las Vegas, because it was really super bad in Las Vegas. But I was talking about Great Financial Crisis, not what's happening right now. To clarify, so we got another one here. Housing will never go down below today's price, except if everyone is broke and you don't want this to happen. So I hear you, man. I mean, I hear what you're saying. I do. I hear what you're saying, but I got to show you, man. I got to show you, okay? I hear you, but I got to show you. So let's do this. Okay, is this the right camera? Nope, it's the wrong camera. So I'm going to show you that despite that comment, prices are going down. So I can actually pull up my MLS if I wanted to and show you guys that prices are going down actually significantly, especially because the rates are in 8%. But we can also go to data center. Remember, in order to go to the data center, you have to type in Redfin News. If all you do is type in Redfin, it's not even going to prompt you to use the data center. That's how much they don't want you going to the data center. All right, guys, let's look at median sales price. So here's median sales price. So it peaked here. It's already going down. You may say this is seasonal. That's okay. But it's already going down. Did they update this? Still not updated. See, as soon as this updates, all the trajectory is going to be fixed, which is completely ridiculous. But let's just go to Austin because I want to save time here. I'm just going to use one of the easiest to read metro areas. So Austin's almost down in prices year over year over year. Okay, Austin is barely above 2021. So prices are already going down. The question is will the prices go down in your metro area? And do you have enough resources and knowledge to understand that prices are going down? Most people are only basing prices going up or down from a quick look on Zillow. Okay, and honestly, maybe you can determine it with a quick look on Zillow, but usually you need like MLS access. But again, you guys, Austin, the home values in Austin are at the same level since January, February, March of 2021. Think about it. March of 2021. So prices are going down. And I believe a few reasons this is here is unaffordability, run up, migration, and new home build construction. And I think that's what you guys see in Phoenix as well. So that's my little thing right there. Okay. So, but go ahead and check, man. Check your own metro. I got a lot of comments from BRN today. You're on fire, BRN. I think it's kind of crazy what builders can do to manipulate and keep their prices high when they're actually not making as much. And I don't think it's right. I don't think it's right because it paints a picture that's not the reality. Now, this has been going on, by the way. They've been doing this, but generally, new home build construction doesn't account for 30% of active listings. So no one cared. But right now, there's so much market share of new homes. The manipulation, in my opinion, is greatly affecting the market because if people are walking a community and there's 100 spec homes, but 50 of those spec homes have sold signs, but they're not really sold, it now has the appearance that they're selling like hotcakes. When the reality is, ain't none of those are selling. So I definitely think there needs to be a lot more transparency with new construction. I think it is a crisis. And the people that are paying for that lack of transparency, BRN, are the recent buyers. Remember the people that I've interviewed, Miriah, I interviewed them, and remember what happened to them when they bought that Lennar? Remember that. I'm not guessing. I'm not, I get a little emotional. I'm an emotional person, but what I'm saying is true. Anyways, Dusty, appreciate you. Oh, Trey, I see you, Trey. Dusty, yo, what's your input on the, I can't believe I threw this one up here. Okay, so I just wanted to tell you guys, as far as the migrants, first of all, I'm from Chino. Okay, I was a minority. I told you guys that. Most of the score was Hispanic. I think I was like 5% demographics. I was white, Hispanic mostly. So you guys, I understand like immigration and illegal immigration, but I love these people. I love the good. I'm not talking about the drug dealers, the human traffickers, all of this horrible, evil people. So I'm torn talking about immigration because I've met some of these people and I've developed a livelihood. And when I was a minority back in Chino, a lot of these people took me in as like the only white kid. And so, and there was like a lot of gangs. I told you guys that, and my mom had to move me out of there. I was getting jumped, but I don't want to knock these people because we don't know what they're going through. Now, the evil sons of SOBs, the evil SOBs, something needs to be done. Something needs to be changed, but I have a hard time talking about the immigration because of that. And also, you guys, I am so scared of the cartels. I could show you guys 20 minutes from my house, the biggest hotspot of illegal immigration. I could take you guys 20 minutes from my house and show you the biggest hotspot for illegal immigration. And I can show you how the developers are milking them. They are profiting. They are getting filthy rich off of illegal immigration. They have a plot set up. And I am terrified to report that because these guys are, I have a family, you guys. I'm not going to do it. I'm too scared. At the criminals. So I'm just not going to uncover it. But if someone wants to report, I could show you everything. I could show you the developers. I am not going to report on that story. Daniel, I've been saving money, guys, and ready to buy. But it's like, how long do we have to wait? If the government turns the printer back on, might keep propping the market higher for longer. So here's what I want to say to you, sir. No one's going to know that answer like you, okay? What I try to do with my channel, first, I know my titles are extreme. I have to get people's attention. It's just the way it works, and I'm sorry for my titles and stuff like that. It's just the way it works. But I'm trying to teach y'all that you have to trust yourself. Okay. In order to trust yourself, generally, you need to understand what's going on. And that's why I'm always putting links in my descriptions, talking to you guys about PE ratio, payment to income ratio. But ultimately, Daniel, this is your decision. If you have a whole bunch of money and you don't want to deal with this BS and you're completely comfortable, no consumer debt, you got a whole bunch of money saved, you could do whatever the heck you want. I'm talking to the people like myself that like we're okay. You know, we're okay. We're not rich. We can buy a house right now, but we're not rich. So how long do you wait? I don't know. I don't know what you're looking for. I'm not trying. So personally, Daniel, I'm not trying to wait. I want to buy a house today. I already looked at the market. If I find a house that meets my checklist, 2019 prices, seller pays closing costs, something that I love, I'm going to buy a house tomorrow. So how long do we have to wait? As long as it takes to find a great deal, my friend, and no longer than that. But also remember this, we don't know how bad things are going to get. So also there's that uncertainty there. So in other words, even though I'm telling you my strategies, I still think like if you don't have strategies built up like I have built, I think you wait till the Fed flips. I think you do, because then something bad happens. And in the meantime, just strengthen your purchasing power, because you're going to take a hit too. All of us more than likely are going to take a hit during unhinged unemployment and recession. In fact, I've already taken the hit, but I'm in real estate. If you're in real estate, you took the hit first. You guys, I'm making probably 30% or more less income, and I've completely stopped originating and representing people. So I walked away from a 6-figure income. So it's been a little bit tighter at our house. Anyways, Trey, sir, I thank you. Now, real quick, guys, I just want to say one last thing. Don't forget, in the description is our Discord. If you want to come hang out, just show the Discord. First of all, I don't know how to use it. Okay, so I'm sorry. It is community ran, so I did not create it. It is ran by Trey. You can see Trey, by Megan, and there's a lot of great people. And I want Discord to act as really just a gathering of people that want to support each other. Even if you guys don't agree with one another, I want it to be about support. Even if it doesn't have to be like, sunshine and rainbows. I'm not saying that, but think about how special this is. We all know each other from these videos. So to have a relationship when I can turn the camera off, to me, that is so refreshing. I told you guys how burnt out I am. Like when I turn this camera off right here, I go back to my emotions. I go back to my daily struggle, right? I'm battling like the burnout. I'm like, okay, what do I do next? I got to edit the classes. I mean, you guys, thank you. I love that community in Discord. I love hearing from you guys. I'm like you. Remember that I'm just a normal person. I am a YouTube fan. So I want to talk. I want to talk to you guys. That's why I take the comments personally. If I didn't take them personally, I wouldn't have met you. I know I need to stop trolling and responding negatively, but you guys, if I don't take these comments personally, then I won't love you. I have to take them personally. It's just I got to keep my guard up, right? Like sometimes someone hits me in the stomach. I'm like, dang. Anyways, I'm so sorry, you guys. Go to Discord, do the free home buying class. BRN, thank you. Just want to give you a quick update. Thank you so much, Miriam. You had some really great perspective today. I hope people understood what you were asking. I hope that I responded to them appropriately. I am just one person with my own perspective. And again, you guys, where's Megan? Megan, this is Megan. So she made the Discord as well. She's really funny. I really appreciate you, Megan. Very intelligent, very much so cares about people. Thank you, Megan. I hope you're doing well. Where's Melissa? Is Melissa here? AJ's in there as well. I think Sheldon's in there. But you guys, one more update on the home buying course. Again, I have everything recorded for my channel members. I'm going to do hopefully a pre-release on chapter 2 this evening. So if you're a channel member, it's 99 cents. You don't have to be, but I always start with my channel members because you guys help me clean it up. Obviously, I'm with the slow reading group. So I'm hoping to do that today. If you're a channel member, if you don't mind, do chapter 2. Give me some criticism. You guys know that I changed it last time. And then after about a week of kind of going back and forth with my channel members, I will be releasing that to the public. But again, you guys look out for that tonight. Chapter 2 is filmed. MFH, you guys, thank you. Oh my gosh, you guys. Megan, thank you so much, dude. It's so there's the community is all of us. The community is all of us. I really want to do something special for you guys. MFH, I really appreciate you. You didn't have to do that. You guys see, it doesn't take money for me to appreciate you guys. It does mean a lot to me. Obviously, I had to change my income. There's some updates I haven't given you guys about my W-2 job as well. I wanted to wait till those updates, but you guys, Just thank you so much. Thank you so much. You guys keep me going. Don't forget that. Show some love to people. You guys, don't forget this. I want you to take away this: higher for longer. I believe prices will continue to adjust downward. I believe that there's a tremendous amount of pressure on prices going down. But in the meantime, empower yourself. Just worry about yourself, your credit, your income, assets. And please, guys, please don't get burned out like me. Okay? Don't play that. If you're depressed, build yourself back up. Remember, you're your best friend. Sometimes I forget that. You guys, stop, man. Mike, thank you, brother. Thanks for the chat. Enjoy. I really appreciate you, Mike. No more super chats, okay, guys? I got to get out of here. I want you guys to buy someone a coffee or something. You don't have to do that for me. I want you guys to know that I'm here with you, okay? Thank you, Mike. Breakfast burritos are fine. I got to get out of here, okay? No more super chats. You guys, I love you. Happy Monday. Worry about you. And for the love of all that's holy, please be proud of yourselves, okay? Understand you are important. Dang it. Art Caffeine. Thank you, Art Caffeine. No more, please. Much love to you, brother. I love your logo. I want to answer all you guys' questions, even if they're hard questions. I try so hard to answer you guys' questions. I can't do it though. I'm just one person. I can't do it. Remember, I have to balance. I'm focused on the home buying course. You guys are getting me emotional. Anyways, I'm out of here. You guys have a great Monday. Love you, Johnny. Love you, Megan, MFH, Sheldon, Trey, everyone. If you're out there investing in real estate, you know I wish you luck, and I hope you win.